now that you've learned how to make a lot of money and you've got a great succession plan and you're going to turn that into wealth that you can live on, I'm going to help you learn how to keep most of it. Because we all know that even if you own your own business, you still have another partner. That partner is the U.S. Treasury. So they take a portion of your income every year. So the first thing we want to talk about is, what structure? There's multiple structures you can have in your business. The most popular one are the pass-through, but C corporations are kind of becoming in vogue again under the new tax law. In most of my career, the only people that used C corps were those with foreign owners or those that knew their exit strategy was going to be a stock sale, mostly either themselves going public or being acquired by a public company. But now with the new tax law, our tax rate at the C level is only 21% on a federal level. There's still the state tax you got to worry about, which each state has varying rates. So you got to check in to see what your state tax rate is and what states you have to file in. The other good thing is there's no AMT tax. AMT tax is a tax that if you fall below a certain level, the IRS says no, you got to pay a minimum tax. For corporations, that's no longer in play, so you can be guaranteed that your most effective rate is going to be the flat 21% on a federal level. We still have the problem with double taxation. If you are a C corporation, the corporation pays the tax, but if you are to pull the money out of the corporation, you're going to pay a second level of tax, whether that is through a dividend. Most likely, if it's your company, the dividend is going to be a qualified dividend, which will be taxed at capital gains rates, which means mostly 15%, but if your income is above a certain threshold, that could be as high as 20%. In addition, if you sell your company, most people who buy companies want to buy the assets. They want to buy the assets because they get a step up in basis in doing so, so they now have a larger basis to depreciate, take amortization on the goodwill. And when they buy your assets, that means the company pays the tax on the sale because the company owns the assets. And once the company sells the assets, it's left with cash. Then you take that cash home with you to retire or to use in another business. That again is going to be taxed again, whether it's a liquidating dividend or a capital gains, you're going to have a double taxation. So although the C corporations rates have gone down quite a bit from 35 to 21, when you do the math, you really need to think about what's my exit strategy. If your exit strategy is eventually an asset sale, it's probably not the form of business that you want to select. The other one more popular that we see is S corporations. The S corporations do not pay tax, except some states do have an S corp tax or franchise tax. So if you're in various states, check with your CPA to see if you do have a tax obligation, even though you are an S corporation. But an S corporation's income flows to the tax return of the owner, and they pay tax at their marginal personal rate on this income from the S corporation. There is, under the new law, a gift to all of us. It's called the Qualified Business Income Deduction. And basically, the IRS has come in and said to allow pass-through entities to be equivalent to C corporations with a lower rate, we are going to take 20% off the top of that income, and it's just not taxable anymore. And that's the simple explanation. It's much more complex than that because it doesn't apply to certain businesses, and there's other thresholds that we'll go into later. But in an S corporation, again, it passes through to the individual shareholders. If you have a passive shareholder, example of a passive shareholder, me and Wayne own a company together. Wayne is an investor, but he doesn't work in that business. He just gets a distribution each year from the profits of the business. He is passive, so he is subject to the net investment income tax, which is the additional Medicare tax that was imposed upon the Affordable Health Care Act that was enacted a few years ago. So his tax rate and my tax rate on that same income is different. He's going to pay another 3.8% if he's a passive investor. So if you have passive investors, you need to consider that, because a real example is we have a client that has two passive investors, a very, very profitable business, and they always distribute money to allow the cash burden of the tax to be paid by the company. The problem is you have two shareholders that have a different tax rate. And because it's very profitable to pay that other 3.8%, it's a lot of cash out of that business. So we go back and forth, how do we handle this differential? Because in an S corporation, all distributions have to be pro rata. So if Wayne and I own it 50-50, if he gets $1, I get $1. So that's, so there's sometimes this 3.8% tax messes up your cash flow planning. Partnerships and LLCs, very similar to an S corporation. And I will say that, and Jeremy will talk about this, but most businesses we see now are LLCs, even if they are S corporations. But in a partnership, same thing. Income flows to the partners. They pay it on their personal taxes. Again, some states will tax your partnership, even though it's a flow-through entity. The good thing about partnerships, there's more flexibility. In that example of Wayne and I being 50-50, I may be able to take more losses, and Wayne may be able to take more income, depending on how the operating agreement is written. And at the end of the day, it all needs to work out, but we can do some tax planning in the interim years before we liquidate the company. And it's also, a partnership is very easy to move assets in and out of. In a corporation, any asset that appreciates in value that you move out is going to be taxable. Good example, Jason, you own a building inside your S corporation. For some reason, you want to separate them, whether you have a new partner coming in and you don't want them to have an ownership in that building. If you were to move it out of your S corporation, we'd have to recognize a gain on the fair market value on the date you move it out of the business, and you get no cash for it, right? There's no cash transaction, so you're paying tax without any cash. So if you ever own real estate, you'd want to own it in a partnership, never in a S corporation, so that you can move things in and out without a taxable event. So keep that in mind. All right, the qualified business income deduction. I know when I said this, I had some people look up and say, what's that? And they, with some curiosity. I'll pass out a little flow chart that will help you understand it a little bit better. But it's real exciting to businesses, especially those that are not what they call specified service businesses. Unfortunately for me, for Jeremy, we're all in the personal service business, so the benefit may not be there for us at all. But if you're in the business of selling widgets or anything that is not a business, that is a service business, this is going to be a great benefit for you if you are a pass-through entity.
Question?
Yes?
You said may not. Is that because it remains to be resolved exactly what that means?
Yes. Yeah, it did. First of all, it's got a go ahead to the next slide, Jeremy. Yes.
So most of the government contractors are in service business. As long as it's not selling a particular person's skills, is that company able to take the pass-through?
Yes. Yeah, then you hit it right. That's what the law says. It says that if your business is based on your skill or your reputation of your skill, that you may be considered a specified service business, and therefore your limitation on the ability to take this deduction is less than a company like that manufactures and sells this pad of paper. So there is, and I'll get into those limitations, but it has to be an active trader business in the U.S. It can't be outside the U.S. And as I said, it's not as available to a service business. Still available, but not as attractive. And as I said, there's multiple limitation thresholds. So the first threshold limitation is 20% of your taxable income net of capital gains. So let's say that you have an S corporation with $100,000 of pass-through income. The 20% deduction would be $20,000, 20% of the 100,000. But let's also say that you have no your taxable income, because you have other write-offs and everything, is less than $20,000. Your deduction would be then limited to your taxable income, not the 20% of the $100,000 pass-through. Well, I guess I went through my example there, but hopefully you can follow that along. The other thing that kicks in, and this is where if you are a specified service business, if your personal taxable income, this is your taxable income on your 1040, if you file a joint return is greater than $315,000, you don't get this deduction. And if you're a single filer and it's greater than $157,500, you don't get this deduction. But if you, so, you know, that's where if you're an attorney, a financial planner, a CPA, someone that makes their money based on their reputation or skill, then if your income is above that 315, this is not a great deal for you. Why they did that, I know why they did it. They basically said that we don't want someone who gets paid based on their earnings in the form of a W-2 to pay more tax than someone who has their same type of business and service but make their money through a distribution from a K-1. That's their reasoning. I don't know if it's valid, but it is their reasoning. Here, go back to the other one. I wanted to use that as an example. The second limitation is W-2 wages. So let's say that you manufacture something and your income is $1 million. Is you're going to be limited to either 20% of that $1 million, that's the qualified business income deduction, or 50% of your W-2 wages. So if you have only $300,000 in W-2 wages, then that 50% is $150,000, which is less than the 20% qualified business income deduction. So you could only take the $150,000. Then there is another test which was put in there exclusively for real estate people, Donald Trump, you know, Coker from Tennessee, that says the next threshold says you can take 25% of your W-2 income plus 2.5% of your unadjusted basis of your assets. The unadjusted basis of your assets is the original cost of their assets if they are still being depreciated. Example, you buy a building for $1 million, you're 3 years ago, you're still depreciating over 39 years, so obviously it's still being depreciated. Your base for this deduction would be 2.5% of $1 million or $25,000. Let's say you bought that same building 40 years ago and you're no longer depreciating it, then you would not get that 2.5% to determine your threshold for this qualified business income deduction. So, and that was put in there for real estate people. So if you're a good example, like we met yesterday with a potential new client who is a law firm, very successful law firm with multiple offices, and they own all the real estate that they're in. Their current CPA told them, you can't have any advantage of this new law because you're a personal service, you make a bunch of money, sorry, you're out of luck. So their investment advisor said, I don't know if that's right. Let me call Grennan Fender and talk to them. So we met with this guy and explained to him that on your law firm, you're not going to get any benefit. But on your real estate, you may get quite a bit of benefit because it's about $10 million in real estate holdings at 2.5%. That's $250,000. So if this real estate business spins off, you know, $1 million of net income, 20% of that is less than the 250. So he'll be able to get the first, you know, the 200,000 off his tax return.
Does it have to be a separate K-1?
It has to be a separate activity, yeah. So you measure it based on activity, not necessarily the entity. But it probably would make it easier in your life if it was in a separate entity, yeah.
It's just some of the tax simplification.
Yeah. Yeah, there is no doubt that this tax law is going to add at least 5 to 10% to my top line this year because it is confusing. And it's going to require us to have annual calculations at the end of the year.
That's why I excluded CPAs and attorneys.
Yep. Good. So here's a good example of what I was talking about. So let's say he's a single realtor. He has $75,000 of pass-through income from his K-1. He takes a $50,000 W-2 from his company. His total income is $125,000. So on the surface, the first calculation is he's got $75,000 of pass-through income. 20% of that gives him a potential deduction of $15,000. Because he's below the net income limitation of $157,000, we don't have to worry about any other calculations or threshold limitations. So he can take that full $15,000. So now his taxable income, assuming he has a standard deduction, minus the $15,000 qualified business income deduction, is now $98,000. So the new rule has reduced his taxable income by $15,000. He's probably at that rate at a 15% rate, so he's saved, who can do the math for me real quick? 15 times 15 is $2,500 about. So it worked out well for Bob. Take the same example, but we're going to increase his K-1 income to $125,000. So now his income is above the $157,000. He's got 125 K-1. He's got $50,000 W-2. So what you do, they do have a threshold. If you're single, there's a $50,000 amount over the bottom threshold where you still get some of the benefit. If you're married filing a joint return, it's $100,000 over the minimum threshold where you still get some level of that deduction. So in this case, he is $18,000 above the threshold. $50,000 is the max threshold. So that's 36%. You take 36% minus 1 to come up with he gets 64% of the benefit. So if the benefit is $125,000 times the 20% deduction times his phase-out percentage of 64%, he would get, and then again we have to match it against the 2% or the 50% W-2 wages, and also the second calculation of 25% of the W-2. So it's really confusing, as you can see. I will point out that in this sheet, the second calculation of the 25% W-2, I've got a math error in there. It's not 26,000, but it's more like 13,500. I can tell you exactly or you can do the math. Yeah, it's 13,750,000. So in this case, the 50% of W-2 would be greater, and he would end up getting a $16,000 benefit from this new tax law. And here's an example with where Susan makes a lot of money. But she has no wages because it's all real estate, and that's the example I used earlier. That even though you have no wages, if you have assets, you still maybe get some of this benefit of this new tax law. Go ahead. And then if you're a sole proprietor, I don't know how many of you operate your business as sole proprietors. The problem here is you still would get the deduction up to those thresholds of 150 and 315. But above that, when we start kicking in the threshold limitations of W-2, if you're a sole proprietor, you don't have a W-2. So if you are a sole proprietor and you're making more than that threshold, you may want to consider converting to an S corporation and starting to take a W-2 salary so that you can then meet the 50% limitation and be able to take this 20% deduction. Again, it's just a free deduction the IRS has given us, so take advantage of it. If you are an S corporation today and you're saying to yourself, well, the C corp rates are so low now, should I switch from a S to a C? And we have had this question multiple times from our clients. And the answer is maybe. And it may be in the fact is that if you're not going to pull out any money, that you're in a growth position in your business and you're going to be using all the cash to reinvest in that growth, then maybe using a lower corporate rate may be advantageous, especially when you're not going to pull out anything for a while and you're building your company up. Again, it really depends on your exit strategy, but in the short run, the other reason you may want to switch to a C would be that you're bringing in investors that are not qualified to be S shareholders, but as long as they're U.S. individuals and some trust, you can still bring them in, but that would be the only reason to switch. I have this example up here to show you that because everybody's thinking about, hey, I'm going to switch to a C because the rates are 21%. In this example, it shows that if you have $200,000 of income from your business, you're going to pay tax at $42,000, and if you got $180 left over to take out of the business, you're going to pay another 15%. So although it sounds great, when you add in even the state tax that you're paying only 21% at a C level, your overall tax is still going to be higher than if you were an S corporation and just took that money out and paid at the highest rate of 37%. So if you're thinking of going from a S to a C, sit down with your CPA and do the math. And obviously with each type of business, you have a different risk involved, and Jeremy's going to share with you the legal aspect of each entity.
So what Jeb was talking about are federal tax classifications and state tax classifications, right? So there's C corps, there's S corps, there's partnerships, there's disregarded entities. Those are all federal tax classifications. It's not necessarily the type of entity for state law purposes. For state law purposes, there's corporations, there's general partnerships, there's limited partnerships, there's limited liability partnerships, there's limited liability limited partnerships, there's not-for-profit corporations. Those are all state law classifications. There's default rules that apply to each type of entity in terms of what that type of entity is by default for federal tax purposes. Certain types of entities can elect. So if you're an LLC, you can elect to be a C Corp, you can elect to be an S Corp, you can elect to be a partnership. And from a liability standpoint, what you're concerned about as a business owner is you get a claim against you and it affects the business, one. Two, there's a claim against the business that affects your individual assets. And then three, if you've got other equity owners, do you somehow incur liability to the other equity owners? And each entity has different rules that are applied in each of those contexts. Generally speaking, a corporation, in terms of protecting you from liabilities of the business, shareholders are not liable for the debts and obligations of the corporation. That's true with an LLC. It's true with a limited partnership. If you're a limited partner, not if you're a general partner. General partners are all jointly and severally liable for partnership obligations. I can't imagine anybody in here is a general partnership. If you are, don't be anymore. Go file an election and be a limited liability partnership. But those are all differing standards depending on each type of entity. They're all statutory entities, so they're governed by sets of statutes. Those statutes apply different rules in different contexts. If you're an individual member of an LLC, for instance, and you get in a car accident and you run somebody off the road, you kill them, you get sued, in a single-member LLC context, that claimant against you can potentially take your LLC interest, liquidate all the assets of the company, terminate your employment, vote your interests, and take over control of the LLC. In a multi-member LLC context, that's not true. They're limited to what's called a charging order. That means they can levy on any distributions that the entity makes, but they can't take control of the entity. So if you're the business owner, that's what you're concerned about. They take control of the entity. You don't have an income anymore. They liquidate all the assets in a fire sale. You don't get the value. So generally speaking, LLC better than a corporation in that context because a creditor of a shareholder can levy on the shares, take the shares, vote the shares, and there's nothing you can do about it. From the standpoint of claims against the business affecting you individually. There's a doctrine called veil piercing that lawyers tend to assert in every case whenever there's any claim and they're trying to get through the corporation to the individual shareholder or the member of the LLC. Lawyers are hyper paranoid about it, so there's a lot of, I think, over planning that goes into it. It's a relatively high standard. It doesn't happen easily. Courts don't do it willy-nilly. A little bit more risk in Florida than in other states just because of our judiciary, but generally speaking, it's a high standard. You have to be using the entity to defraud people. You have to be commingling your personal assets with your business assets, so don't do that. When Wayne was talking earlier about quote, discretionary expenses, lawyers point to those things after the fact and say, look, this isn't a business. It's really this guy. It's the same thing. He's running all his personal expenses through here. He's writing, checks for his home mortgage. So it's another reason, not to do that. And then in the context of claims of other equity owners, if you have multiple equity owners as opposed to a single owner, in an LLC context, you can limit fiduciary duties in ways that you cannot in a corporation. Corporation, the fiduciary duties are statutory. You can't limit them. You can't vary them. In an LLC, you can do a lot of things that limit your liability to other equity owners. So if you're going to have employees, for instance, who are issued stock for services, ideally you'd rather do that in an LLC than in a corporate context. Judd.
Just quickly, I know that Wayne touched on this earlier when in the presentation, but you can be a cash basis, accrual basis. I think in your businesses, being accrual basis is almost necessary because you want to capture the cost in the right timing in the right period for book purposes. And for tax purposes, you probably, if you don't have to file an accrual basis, being a cash basis taxpayer is the better way to go. Yep. And the good thing is the new tax law has increased who can be a cash basis taxpayer up to $25 million in annual revenue. There's other rules with inventory and stuff that you have to abide by, but it used to be 10 million, now it's 25 million. It seems like the new tax law has made 25 million the threshold for what's considered a small business. What else is good about the new tax law is depreciation write-off. If you are a high asset-based company, they are now allowed 179 deduction up to $1 million of new asset acquisitions, and the top line is 2.5 million. So the top line being that if you buy more than 2.5 million in new assets, your $1 million of 179 deduction starts to phase out. But for now, we don't care because there's what's called bonus depreciation. Bonus depreciation is 100% of any new assets you buy. You can write off in the year of acquisition. And the really good thing about it is the former law on bonus depreciation said that had to be a brand new asset. It can't be something I bought from Jeff's company. It has to be new to the business world, so I have to buy it, from the manufacturer. Now that says it only has to be new to you. So I can buy a piece of used furniture or anything, and I can write that off in the year of acquisition. And that phases out over the next 8 years. So, by 2025, it goes away. And my last comment is, why do you need both? If you have 179 can't create a loss where bonus depreciation can. So if you're in a situation where you want to pass through losses and you have acquired a lot of assets that year, electing the bonus depreciation allows you to create a loss in your business that you can then maybe take and offset other income. Where 179, you can only take 179 to eliminate income. You cannot go below a break even on the 179 deduction. The other great thing and that's available to small businesses is pension planning. And Chris is going to walk us through the various pension options that are available to small business owners.
Thank you, Jed. We'll kind of keep it short and to the point, but feel free to ask questions, obviously. The most common is 401k. Virtually everybody's heard of it, but but you've heard a lot of discussion on income limitations, loss of deductions, things of that nature, right? So not just a savings vehicle, obviously the primary tool, but ultimately at the end of the day, it's a tax management tool as well. So if we can have Uncle Sam contribute to our retirement account directly or indirectly, these frequently make sense. So 401k, pretty common. It says 18,000 and 24,000 effective 2018. That's been bumped by about 500 bucks. So 18,500 is the maximum amount you can put away. But if you can add a profit sharing or an additional component to it, you can actually get up to $60,000 a year, $61,000 with the new contribution limits into these plans, assuming, of course, you're the business owner, with the company matching.
I had a question.
Sure.
I have a business partner that we own the company together. Do we get capped out with highly compensated employees?
Great question.
We only get to contribute like 6%.
That's exactly correct. I mean, one of my biggest complaints, right, business owners are jamming it in there, but I'll just use receptionist, is putting in, $100 a month. Well, they max it and they get a check back at the end of the year, to his point. One of the things that do that, almost a perfect transition there, safe harbor versus a conventional plan, right? So he has a conventional plan, so he continues to get tested. They're actually more expensive to administer because of this testing, because they don't want it to be what they refer to as top heavy. They want to make sure that everybody has it in place so that you're not just putting it in place for the highly compensated. By implementing a safe harbor plan, which I'll explain in a minute, you can eliminate that testing completely if you honor a few basic things. One, you have two choices. You can say, we're going to get a 3% non-elective contribution to every employee, period, right? Now, that might be an expensive endeavor, depending on the size of the company, where you're at, things of that nature. But it may not be, right? To your point, if you're trying to get more money away, you're paying taxes on money you would love to put in your retirement plan. Uncle Sam's savings, if you would, or your savings Uncle Sam's, could offset some of that cost. Very common where we see those plans virtually pay for himself when it comes to the business owner. The other option is a 4% matching. 1% higher, but you do not have to contribute to everybody across the board, right? So frequently your CPA, your TPA, third-party administrator, often gets involved in these things. They can do the math for you and say, what would that look like in my case? So which is the best option?
So if you have a lower participation rate or below a certain threshold, the 4%.
That's exactly correct. What I frequently see, right, I'll use a real world example. It's a plant fern company, right? So they have a lot of, I'm going to use rank and file employees and a few key executives and 2 owners, right? Well, they use a 4% because some of them don't even put money in the plan. You've talked about it 100 times. They don't do it, and some that do, they might put 50, 60, $100 a month into the plan. The 4% saves them thousands because their payroll's respectable. They're just not contributing. So good point.
How does it come to 61,000?
So the 18,000, which is now 18,500, refers to employee deferral. So employer can put more money in on top of that plan, and I also included the $6,000 catch-up contribution for those over 50. So that total contribution now goes to $61,000. So if there wasn't a profit-sharing component of that or a matching component from it, obviously that's the maximum the employee could put in there. But frequently you're the owner and the employee, so we can put that money away.
And just to touch on the vesting of everything above the 3% or the 4%.
Yeah, so there's a couple different vesting options. Now it's basically capped at 5 years, right? So you can put a vesting schedule no longer than 5 years on that matching contribution. So, for example, I'm just going to use a number. You put in $1,000 for them, and we can vest 20% of that per year. So Jeffrey brings up a good point. So A, you may not have given all that money away if the tenure, doesn't stay, but B, it will help retain some of these key people, right? So they want to continue to get the vesting or receive the assets that you contributed. So that's a powerful tool for that. Good point. Employer matching, I just kind of went through that. Defined benefit plan versus defined contribution plan. The 401k is a defined contribution plan, right? You're putting money in. Where a defined benefit plan is you're guaranteeing money. Money's being set aside in essence that's going to provide a benefit in the future. We bring this up because cash balance plan could come back into favor fairly strongly. You heard Jed touch on sort of that 315 income limit, right? Well, cash balance plans, we can design these types of plans where you can put away over $200,000 tax deferral. You want to kind of go into a little bit of...
Sure. When I spoke about the qualified business income deduction and the 315 threshold, I mean, we've already done planning for quite a few professionals we work with to say, hey, your traditional income is about $360,000, $370,000. Let's put in an aggressive pension plan so that with that deduction for the pension contribution, it now brings your taxable income below the 315, and now you get the full 20%, whereas you would get zero if we didn't drive your taxable income below the 315 threshold. So basically, the IRS is contributing 100% or close to it to your retirement. I mean, that's a great deal. So if you're in that situation, you're saying, oh, I'm in a personal service, my income's over the 315, what do I do? Get with your financial advisor. Design a pension plan that can work to drive that number below the 315. The IRS is basically going to fund your pension for you. So you got to do it.
Hey, Jed, too, real quick. So, the time for tax, some people think tax planning is, February 15th, I'm going to go to my CPA and I'm going to give him a bank box full of documents and then he's going to go prepare my tax returns. Well, it's a calendar year tax period, so we can't undo what was done in the prior year, right? So the time for tax planning is not after the end of the year, it's not December 1st, not November 1st, it's the beginning of the year, so that you can plan this stuff out over the course of the year. And when you do that, we can be a lot more effective in helping you. So make sure you're talking to your CPAs early in the year and throughout the year, not just after the end of the year when you're bringing your documents to me.
And that's really, truly a huge point. We talk about true professional collaboration, at our firm. And one of the meanings behind that is not asking how much, or reporting how much your client contributed to the 401k and sending it to the CPA. It's meeting ahead of that, to Jeremy's point, prior to the end of the year, to put a plan in place so we're strategically and on purpose designing our tax bill, right? Sometimes we don't have 100% control, but we try not to let the tax tail wag the dog, if you would, on all of the decisions. But to Jed's point, if we can have Uncle Sam fund your retirement or pay for your employee benefits, those are strategies that frequently make sense. So the cost is not always the sole decision maker, right? So you start with sort of what we would refer to as discovery meeting, or thinking through why it is that you want to do what you're trying to do. If tax is a primary driver, you'd be surprised partnering with professional people that know how to do those things. They can also oftentimes pay for themselves. That's you, boss.
All right. Some other deductions, especially in your industry, you want to consider is one is the R&D tax credits. That's a great opportunity if you are in the and here's what you take away from this is there is so many things you do that could qualify for R&D tax credits. Don't just assume it doesn't qualify for you. We work with a few groups that do the studies for our clients, and we're amazed that when we give them a list of clients and what they do, they come back and say, well, this company has an opportunity and this company has an opportunity. And we would never have thought that had we just opened the books and said, hey, this is what they do, what do you think? And they came back and said, yes, there's an opportunity. We had a company get over $200,000, two companies get over $200,000 in tax credits last year. One is an online school. Would you think an online school would qualify? But they did, because they developed their curriculum online, so they're using technology to build a platform that delivers the content to the students. So we were able to get a $200,000 plus tax credit. So he's not going to be paying any income tax for a couple of years now. And what can he do with that money? He uses it to make more curriculum, build his school up larger, and now he's got a more valuable business and a bigger payday when he exits the business. And the other good thing about it is, and this may pertain to some of you, is that if you're considered a small business, which means 50 million in revenue or less, and and you're in a startup phase, and your gross receipts are less than 5 million, you can use your tax credits to reduce your payroll taxes. So that's a new thing that came into effect last year. So if you say, well, what good does R&D credits have for me? We're developing something, we're not making any money, we're not going to make any money for a while, what good is it? Well, you may be able to offset the payroll taxes of your employees. You know, there's a lot of tech companies in this situation where they're not making any money, but they're paying a lot in wages because their programmers are building the product that they're eventually going to monetize. And here's a way for you to use the credits to offset your payroll taxes. Cost segregation studies. If you own a building that your business is run out of, a cost segregation study says we're going to look at the engineering plans of that building and we're going to try to classify the cost of that business into shorter useful life assets. Best example is you got a big IT room where all your servers are, and therefore you need to raise the floor to keep it cool, you know, and that raising that floor may add, you know, $30,000 to concrete cost or something like that. And that concrete cost now can be assigned to the servers, which have 5-year useful lives versus 39-year life of the building itself. So if you own your own building, look into having a cost segregation study. It will increase your depreciation right off in the early years, which obviously with the time value of money generates positive cash flow. And any questions for any of us on any subject? We'll open it up to, yes, sir.
I just got a statement. We found out about the R&D tax credits, and a surprising portion of our business can take advantage of that. So, for instance, firm fixed price contracts, a lot of that work is considered at risk, and so would qualify. Payroll would qualify, and you can do it retroactively. You can go back and recast previous tax years, and that's a tax credit. That's
Yes.
That's off your tax bill. Like
Yep.
that's money from heaven.
Yeah, yes, it is.
Everybody needs to look into it.
Yep. That's my point, is don't assume you wouldn't qualify. If you think at any remote chance you qualify, talk to an expert in this industry and you may find that you get, and you're right. And the way they usually price it, some will price it as a percentage, you know, where they'll sit there and say, we think you're going to get $100,000 in credit, so we're going to charge you $30,000 to do the study. But again, they usually know or are pretty strong in their prediction of what you're going to get. So, you know, who wouldn't pay someone 30 cents to get $1 of a get back from the government?
Audit protection a lot of times.
Correct.
Yeah.
Right. Yeah, one point on that is that the feasibility study doesn't cost you anything. So you can talk to us and we'll estimate what it is based upon what you tell us. And then if it looks good, geez, I'm gonna get $100,000 of tax credit, then we'll actually go into the study deeply.
Yeah.
Yeah, I would second that. I went through the process and I couldn't get any value from it. It cost me zero, so.
There you go.
It doesn't cost any of you owners anything to look at it.
Right.
Might as well do it.
Correct.
So are you all from the same company?
Jeff and I are.
To me,
Yes.
like you all have different things to offer.
Yes.
So how do we connect with you?
Actually, very simple. Everybody signed in, and I'm gonna send a thank you note out to everybody. That's one. But our CEO Leadership Forums group is 20 companies, all right? You feed back through me, and everybody will be on here, all right? So if there's a question, I'm gonna route it to the right person, and they will get right back to you on it.
And also in the back of the book is all of our information
Correct.
conveniently located
Yes.
with our phone numbers that we answer quite often. So,
Yes.
that too.
Yeah, that's right.
Yeah.
Question too. If you don't meet regularly with your CPA, your attorney, and your financial advisor, start doing that.
Yes.
Because, you know, don't do that. Attorneys view things from a legal standpoint. CPAs view things from a financial accounting tax standpoint. Financial planners view it from a different standpoint. And what will happen is sometimes they'll be doing things at odds with one another because they're focused only on that particular aspect. So make sure you're meeting with those people regularly, that you're in conversations, that they're talking to each other, that you don't have the lawyer going off and doing things and doesn't know the tax consequences, because then it gets to Jed, and then Jed's like, why did you do this way? You just cost yourself $100,000 in tax. Right? The time to avoid that is on the front end.
And that's a perfect point, because when we work with clients, we have a cabinet. Okay, so your cabinet is going to meet with you, and we're all going to talk about the various issues. So you only have to talk once and make a decision once, right? Even if if you have outside people, it's our responsibility. It should be everybody's, but we bring them together so that we're communicating at the same table.
Well, that's it for me. One final comment is this new tax law is anything but simple. So engage with your CPA, your tax attorney, and make sure that you're doing what you need to do today so that you minimize your tax at the end of the year, because it's nowhere near simplification. So thank you.
Okay, Jeremy, you're up.
So Jeff, we're running late here, so you want us to just whiz
No,
through
we're
the points?
okay. We have about 15 minutes.
Okay. All right, so we'll try to go through this a little bit quickly, because I know I do not want to, nor does Chris want to be responsible for keeping you here late, so.
Or not eating. Yeah, I think, we'll really pick it up. We put some stats up here, because, well, for one, everybody gets numbers. But, I was in a meeting yesterday with a group of business owners, literally ranging from $3 million to $300 million in terms of revenue. And the various concepts or thoughts surrounding business succession plan and looking at those types of things were all over the board, right? So, some of the business owners were really dialed in, had a fine-tuned exit plan, knew when they wanted to do it, knew what the outcome of it was, but that was the small minority. In fact, there was one, so everybody else in the room really was trying to figure out, when do they want to get out of this? How do they want to get out of it? What does it look like? Things of that nature. And some of this impacts planning, right? Jed mentioned earlier, C Corp versus S Corp, right? If you're going to get out of the business as an asset-based company, maybe you don't want to look at C Corp. So we wanted to touch on some of these planning things. 79% of business owners plan to exit their business in the next 10 years, right? Well, I guess that assumes you had a date. Frequently, when we're talking with business owners, it's probably the next 10 years. Reality is 8, 9, 10 years comes, and they're still, that rugged individual that kind of keep plugging along, sometimes because they have to, sometimes because it's fun. 75% of business owners would exit today if financial security were assured. Big challenge for business owners selling their business. They go, okay, I make an X amount of dollars a year for my business. How do I replace that income, right? So that's a good part of it. 80% of business owners believe that successful exit will result from careful planning, yet so few actually put the plan in place. And it makes a tremendous difference. We tell clients, listen, let's put a hypothetical date on your business exit plan, even if it's not something that's on the radar today, right? Putting the things in place, which isn't all financial related. Your leadership team, I know Russell touches on this a little bit, Jeffrey touches on this a little bit. If you want a self-managed company, that is part of, believe it or not, exit planning as well. Think about valuation. If you are your company or your biggest resources, is your company worth more or less? Less, right? Fairly simple. But in theory, if they don't need you, and that operates with or without your presence, obviously valuations go up substantially. Next. We touched again a little bit on that. It's all around the same thing. But the point that I wanted to make is 100% of the business owners are going to leave their business one way or another, right? That's inevitable. It's like death and taxes. It's unavoidable. So putting a plan together is obviously the best way to do that.
By the way, too, there's economic cycles, right? Valuations go up and down. Right now, they're very high. If you were selling your business in 2008, probably not a great time to be selling your business. So keep that in mind, too, you know, sometimes you're going to get dictated to you what valuations are, irrespective of what your business is like. So you got to take that into consideration when you're doing the planning too. You know, if you're planning at the height of the market, you don't know whether it's going to be up market, down market, and if you're compelled to sell because health, age, whatever it is, you may be selling in the wrong market. You're going to lose a lot of value.
Yeah, death and disability don't discriminate market cycles, right? They don't care where it's at and what's happening. So having that plan in place can really be important. And I'm going to wrap my part up with this and turn it over to Jeremy, but this really goes back to sort of what Jeffrey and all of us were talking about a little bit. True collaboration makes a huge difference. Like Jeremy was saying, operating in a vacuum, and it's not a good attorney or a bad attorney, a good advisor or a bad advisor, right? Everybody has their perspective or respective areas of expertise in that different lens, right? A forward-thinking lens or a rate of return on the market or market cycles don't always impact taxation, right? They don't always impact legal and liability and things of that nature. So regardless of who your people are, if you would, put that team together. And we just put a slide up here to sort of talk a little bit about it. Obviously, we believe the core of that group is your CPA, your attorney, your advisor or wealth manager. Insurance is critical, right? So as all that happens, and everybody's business is a little bit different and everybody's situation a little bit different, and they may require different areas of expertise, right? Jeremy's one of the top business lawyers, right? You may also add an estate planning attorney. Now, you could get them at the same firm, things of that nature, but so there's various areas of expertise that you would want to look at. But assembling that team, proactively getting together, having these meetings, and we call planning on purpose, makes all the difference in the world. God forbid death or disability does occur. In the event those things were in motion, you're twice as likely to succeed in transition, right, with much higher valuations than you ever would be in the absence of that planning. So I'm going to turn it over to Jeremy at this point, just for the sake of time, and go from there.
So one thing I'd say too, you know, lawyers, financial advisors, CPAs, if you're a CPA, that doesn't mean you're an expert in tax, audit, you know, all aspects of accounting. People have different specialties, right? It's no different than going to a doctor. You wouldn't go to, you know, an orthopedic surgeon to have heart surgery, right? So if you're going to go do this, get the right professionals, get people who have experience in this area. It will make a tremendous amount of difference in the value that you get for your business. It will make a tremendous amount of difference in the risk that gets allocated you in the transaction. So I would commend you. Go talk to people who are specialists in this field. I want to give you guys just a quick example, and this is a real-world example. So when you decide you want to exit your business, that process needs to start well in advance of when you're selling your business. Not 2 months, not 3 months, not after somebody presents you with an LOI. It needs to be 2-3 years in advance for a variety of reasons. And what you find is when people engage in that process in advance and they get the right people on their team, they get valuations that are astronomically higher than when they don't. And sometimes not only astronomically higher, but sometimes the results are catastrophic, as we'll see in a second. This is a client of mine, came to me, I'd say 2.5 years before they were looking to exit, put a strategic plan in place. They had an outsourced CFO, they had a financial advisor, they had an investment banker, lawyer, estate planning attorney. This is a company that was growing pretty rapidly in a niche area that was getting very high valuations. They go to market initially, get an LOI from a buyer. That LOI is at $35 million. Transaction fails because the CEO of my client doesn't have alignment with the CEO of their client. Second potential buyer about 6 months later offers $42 million, so another $7 million. That transaction fails for similar reasons, goes away. Client waits about 12 months. Company continues to grow. They continue to meet projections, so they've got a stronger track record of projections, meeting those projections or exceeding them. They go into an auction process with the investment bank, get widely varying offers, but end up selling the company for $58 million. So that's 12 months, $18 million. Oh, sorry, $23 million. That's a big difference, right? So the reason for that was obviously they're growing and they're getting good multiples, and as you're growing EBITDA and you're getting a multiple of EBITDA, those numbers ratchet up very quickly. But it just shows you the importance of actually doing pre-transaction planning. Now we'll talk about somebody who came to me and didn't have such a good result. So this is company, get an LOI, letter of intent. So that's how the exit process usually starts. Buyer comes into the picture, submits a letter of intent, says, I want to buy your business. Here's the general terms that I want to buy it on, and then they start doing due diligence. No pre-transaction planning has been done by the seller. They get into due diligence, find all sorts of things. Letter of intent goes from $8 million initial purchase price down to $5.5 million because of what they find in due diligence. They end up doing the transaction, get into a dispute post-closing because reps and warranties are either not accurate or not fully accurate. They find a bunch of things. The company starts tanking. He gets into litigation. Owner walks away with, has settled litigation, walks away with $1.5 million. He's, doesn't own the company anymore, can't replace his income, and can't retire. So that's an example of what happens when you don't do pre-transaction planning. If when you sell a business, the first part of that sale process is generally you're submitting some narrative about the business to the buyer. The buyer's wanting to understand what your business is about, why they should buy it. And the more that narrative does not correspond to what they find in due diligence, the more they're going to beat you up about price, the more they're going to allocate risk to you in the transaction documents, the more they're going to assert that you individually as the owner needs to be on the hook for the reps and warranties and personally responsible for indemnifying them if what you told them isn't accurate. So that's reason enough to do pre-transaction planning. But when you go through this process 2 to 3 years in advance and it's all cleaned up, your contracts are clean, you have assignable contracts, you have your intellectual property protected, you have your employees incentivized to consummate the transaction and stick around for the buyer, the valuations are astronomically higher. So don't try to avoid the front end costs only to pay 10 times on the back end.
I was just going to add briefly to that. So and Russell and Jeffrey touched on this a little bit, but when you start thinking like a buyer, right? When in Jeremy's last example, they come in there when this is sort of I'm going to say it, a whim transaction. They're picking it apart in terms of the negotiation, right? The really simple examples. If you're selling your house and you got a foundation crack or your roof needs leak, your roof's leaking, or you got electrical stuff that's not working or whatever, you would want to fix all of that up front, because once the negotiations start slipping just a little bit because they found this, they found that, they found this, they assume there's a whole lot more stuff going on they just haven't found yet. Same is true on these business transactions that we've seen. When they come in and they start the due diligence process and everything is tight, everything is accounted for, outsourced CFO is in place there that's going to be continuing in the process. The CPA firm knows exactly what's going on. The key people, as he said, are incentivized to stay around. The opposite is true. It's now a confidence thing, and cost matters, but not as much as it did. So bidding wars occur, things happen like that. The final thing I would say on that is one of the struggles we see is, what do I need to get for my business? Know that going into the transaction, right? If everything's good, it's not a health reasons that you're leaving the business. Know what you need to get to either replace your lifestyle, meet your demands, your desires, things of that nature, before you enter a letter of intent. Because after the fact is not the time to figure out this isn't going to work for me, right? Once you're in it, you're in it. And it's going to cost money either way.
Yeah, I think people think about selling their business, I think, the same way that, like, when you were in college, you thought about a job, which was, well, if I make $50,000 and I divide that by 12, I'm going to get $6,000 a month. I can live on $6,000 a month, or $5,000 a month, I should say, right? That's not the way it works. The tax man takes some of that, and it's the same thing when you sell your business. So you got to look at it on an after-tax basis. You have to do very detailed analysis, and it has to be people who know what they're doing, or you're going to get unwelcome surprises on the back end every time, and it's not going to be a welcome one. So you got to know what that number is. I have people who come to my office and say, I want to sell my business, and my first question for them is, well, what do you need to get for the business in order to retire? And their answer is, I'd say probably 80% of the time, something to the effect of, well, I think I need about $3 million, or I think I need about $3.5 million, or $4 million, or $5 million. And I'm always like, well, what do you mean you think you know? Like, you need to know. Like, you can't replace your income. You're not going to get another job that pays you this way. The business is going to be gone. And then, what happens? You're going to go back to work 20 years down the road in retirement without enough money because you're forced to go back to work. So be deliberate about that. Know what that number is, and make sure you know it very specifically, because you don't live for 10, 15 years in retirement anymore. You live for 25, 30 years, right? So think about that. It's a much bigger number when you have that much longer lifespan. So I won't get into too much of this because I want to leave a little bit of time for you guys to ask questions. But I guess in summary, what I would say is just make sure you're doing this in a deliberate way. Make sure you have the right people. Make sure you think about it. Don't do it in a haphazard way. It is, for any business owner, it is the biggest transaction of your life. And it can either destroy you financially, or it can be a windfall and help you retire and take care of your family. But if you don't do it right, it ends up in litigation. It ends up in less value, and you end up having to go back to work. So that's not a good outcome.
Yeah, I'd mentioned briefly the meeting that I was in yesterday, but one of the gentlemen had an offer, $24 million on his business. One of the things that was really cool about it from my perspective, he said, I had no intent on selling. I had 5 years longer in my timeline. This is his second business, so it was a little different than his first transaction. But he said what they were looking at when they came in to examine my business changed my business plan moving forward. Because now, all of a sudden, I'm going, okay, here's the dials that they're looking at in my new industry to maximize valuation, right? So I found it interesting that he just made slight tweaks in what he's going to do, and he plans on re-engaging in buyers as they approach him, rather than say, no, it's not for sale, and continuing to do that. He's had his third offer on it now. So his first, he said, was $15 million. He's up to $24 million. He says he thinks he can continue to tweak it to get to $50 million inside of 5 years. So all preparation, and just an interesting hearing him say. So if somebody is interested, maybe you listen, even if it's not the time to sell. It's a great exercise. Any questions?
Well, first of all, thank you for bearing with us. This is a little bit of a sprint, but thank you for staying with us. I passed out everybody an evaluation form. You could put some check marks there. Your feedback is always very, very helpful. Those of you who did a value driver assessment, I know we have two here. We'll talk about that offline. Those who want to do a valuation, I have sign-ins, all right? Some of you sent financial data already through our secure portal, all right? That'll be in process. But anyone who wants to do one, all right, $75, $50 value, giving this to you as a start to basically hit the points that we're dealing with here to the number. And this is a 32-page report. I think it's very, very helpful, and it'll bring to light a lot of the things we were talking about today. So if you have not signed up, the sign-up thing is over there. We'll be reaching out, and it won't be everybody. It'll be one person. I'll start, and then we'll be talking through one channel, so you're not bombarded. Okay? It's very, very organized. All right. All right. Thank you for your time. God bless you guys. We'll talk to you later.
All right, there's been some big round of applause next talk.
There we go.